Welcome back to the Loan Lads. Today we're going to be talking about something bigger than just one loan or just one flip. We're going to be talking about long-term partnerships with your lender.
Think of it as dating. We don't care about what you look like. We care about getting your deal done and getting you the best financing option for your current scenario.
And before we kick it off, don't forget to check out parkplacefinance.com for your trusted nationwide lender. All right, Joe, so let's talk about why it's important to build a long-term relationship with a lender as an investor so that you can scale your investments.
Yeah, for sure. So all investors, really what they should be doing, and as you scale, is really building a team around you, whether that's contractors, maybe wholesalers to help you find those deals, lending partners, realtors, right? Having a team around you as an investor is going to allow you to scale, and that's how really you turn from being a somewhat passive investor and just doing one or two deals a year to just supplement your income, compared to actually going full time into real estate and really making a business out of it to where that is your main source of income. Relationships in every aspect of the business is super important to be successful and actually be able to turn and burn these deals in a better cadence than maybe one would without these type of relationships. So, in all forms of business, relationships are super important, but in our business, especially with lending, relationships really make the difference between those investors that can really scale quickly and maybe those investors that are struggling to get out of the 1 to 2 deals a year, even though they do want to expand.
Yeah, so touching off of you explaining how important relationships are, especially in the real estate business, everything is built off of a relationship at the end of the day, right? So whether that be, the investor to lender relationship, also what's important is our relationships as a lender with other third parties, right? And so I think that's the first piece to kind of the puzzle is, as an investor, you want to have that relationship with your lender, right? But also you want to have a relationship with a lender who has those third parties, right? Whether it's a good title company, maybe it's a nationwide title company that moves fast, right? You got a quick close, a title company's got to move on a dime, right? Or even a insurance rep. A lot of times we come across, especially in certain states that are hard to get insurance, like Louisiana or Florida, you've got to have an insurance rep that's able to get you a policy that's needed and also get it done quickly.
For sure.
A lot of times you'll run into a stopping block on insurance, maybe where you're in a flood zone and they can't get you flood fast enough, right? Having that insurance rep that you've done it time and time again with, where you can recommend them to a client, they move fast, the premiums are standard for the industry or the market. Having those types of relationships to offer to your investor is also allows you to speed things up throughout the process and allows closing to be much smoother as well.
Yeah, absolutely. And that's a great point. Having that relationship with us who has relationships with insurance, title, appraisers, contractors, like every facet of the business we kind of cover there. So not only does it enhance your financing side of things, but it also enhances the doors that are open to different people within the industry working with a lender like ourselves. And that brings up a great point in terms of it's much easier to close a deal once you have that relationship compared to it being a first time, right? I've got guys that are doing multiple flips a year, and we already have the documentation on. We have the title contact, we have the insurance contact. They're really invested in the same place, so we're going to go back to the appraiser who we know can get that report back to us in a timely fashion, right? So all those things, once they get that request, whether it be title, insurance, even us, we know exactly what to do, and those third-party items typically come back to us way quicker than maybe a new investor, to where I'm trying to figure out which title company to use. I'm trying to figure out which insurance to use to fit this specific lender. When you work with a lender time and time again, we know the insurance is going to work. We know the title company that we used last time is going to work. We know that maybe the contractor that they're using is going to work. So the confidence in that deal closing, once you've closed one with a lender and then you start building that relationship, every time that you close a deal, that confidence score goes up, goes up, goes up. And we can see that you're actually performing on your loan as well. So you're going to get the same underwriter as you did on your previous deal, who knows the client, who knows the documentation, who knows how everything's set up from the LLC to the contractor, right? So really, as a lender, we get the full picture of a client on the first time, and then especially when they come back, that picture expands, and we know that client more and more every time that we do a deal.
Yeah, the first underwrite's always like the story, right, of the whole exit strategy, or maybe the client's investment strategy as a whole, where we can really underwrite it and look at it. So we know their assets, we know their exit strategy, we know what their contractor's doing. For example, let's say it's a builder, right? A lot of these builders typically build the same plan a lot of the time. So like you'll have an investor come in and build one house, and they'll duplicate that 5, 6, 7 times in a year. If we underwrite it the first time, the comps are typically the same.
Right.
Obviously, they change now and then throughout the year, right? So you get some more recent comps, but the floor plan's the same. You're going to use typically the same AMC appraiser. You're going to use the same title company, as you stated, insurance. So the underwrite is much smoother, but also it really speeds up the timeline. So you'll see, maybe the first deal is a more complex deal for a first-time client, where they'll come in, and that could take anywhere from 5 to 10 days for approval, right? But maybe they bring that second deal in, and you already have all the third-party contacts that you need that did the first one, and you already know the client's strategy, you know what they're building. That timeline could speed up to 3-4 days, right? And we see it all the time. And I think that's what allows clients to really scale and become a repeatable investor, is having that relationship with a lender who understands the product and really understands what they're doing as an investor as a whole. And to touch on you, like underwriting is the biggest aspect of it, right? So when these underwriters look at these deals, we look at it as risk. At the end of the day, we're the ones lending the money, right? So we're going to look at it as like a common sense underwrite and take a holistic look at the risk of the file. Once you do the first one and you've made payments on time, you were actively going through draws on the construction, so you got a 12-month loan, but maybe you finish that construction in 4 to 6 months. We know you're moving quick. We know your contractor's doing everything needed. So looking at that and then coming back at the second project allows us to provide a much faster approval, and we also trust the product.
Absolutely. No, for sure. I kind of want to move on to the scalability and how that relationship helps to actually scale your business with a lender. So first of all, as an investor, typically people start with a small flip, right? Get the feet wet in, $200,000 purchase, $30,000 cosmetic, got a good ARV, they flip it, they're successful. Really what they're trying to do is get the feet wet in the real estate game, right? But as we know, there is other investments in real estate that we lend on that maybe are more lucrative, but take experience and take more knowledge to actually get to, right? So having the relationship with the lender, once you start small maybe, it really allows you to grow up to those bigger deals much quicker compared to coming in with one of those bigger deals and trying to get approved for maybe a $300,000 budget, which we definitely would do. It's just a more intense underwrite, I would say. But once we've underwrite these smaller deals and then you move up to a project that's a little bit bigger, well, you've already proven yourself on these smaller deals, right? And you've proven yourself that you're making payments, you're doing your construction, you've paid off the loan, you've been successful. We're much more inclined to get that loan approved for these maybe a little bit more difficult loan.
Right.
Some would say difficult, right? Once you've actually done multiple loans with us. So,
and I think it also allows you to look at different types of investments, right? So you'll have an investor come in that does maybe like you said, a small fix and flip, and the next time they come back, maybe they're going to scale up to a little bit bigger and then a little bit bigger, but then they'll jump into a different category. Maybe they want to stop doing fix and flips and they want to now go build houses from the ground up, right? Or maybe they want to jump into the multifamily space. It's becoming very popular, especially to fix and hold, where you can buy a 5+ unit property, fix up the units, and then rent them out. Right, so that's definitely a more complex underwrite as a commercial property, and we do those. However, we want to see that you have experience. So maybe you don't have multifamily experience, but you've been a repeat borrower of Park Place. That's a much smoother underwrite, and it allows us to really understand you as an investor and your track record as well. One last thing I want to touch on too that I think is important for investors to know that are watching is not only is the lender kind of your trusted source in getting the deal to the finish line and that partnership being so important, but also like we talked about previously, the relationships we have. Maybe an investor wants to get into a product that we don't offer, right? Maybe it's a mixed-use property, or they want to go buy a retail or industrial space, something that we don't offer. We talk to lenders all the time, right? We go to conferences, we're on the phones all day long. We know a lot of lenders out there that do a lot of products that we don't offer, and they send us deals that maybe they don't offer, right? And so we have that referral business, and we'll go build those relationships on the back end. So it also allows us to refer clients to maybe another source if they're looking for something that we don't offer. It's always a value add, right? And I say this a lot, but it's a value add business at the end of the day. So if I can provide value to the client in some form or fashion, then I think that's what allows the relationship to continue growing.
Absolutely, yeah. And these relationships that we have with other lending partners, they're really trusted relationships. So, it's proven with us since we've actually sent clients there before, and we actually know that they can actually close these specific deals. So the relationships work on both sides, right? It works on the side between the client and the lender, but also the lender and other lenders in different lending categories, right? So having that ability to the third person and we're the middleman through different lending sources is super helpful for investors.
So let's touch a little bit on the role of the trusted lender in these partnerships.
For sure, yeah. So, the investor has their roles, which is to actually execute on the deal. As a trusted lender, to be in a good partnership, we have to be reliable, we have to close with speed, and we also have to be knowledgeable about really what our investor is doing, so we can actually give them some advice as well in terms of what we see in any specific deal. So first off, in terms of speed, I always think it's like a coffee shop, right? The first time you go into a coffee shop, you have to go up and you make your order. Once you're a repeat customer, sometimes you can walk into that coffee shop and the barista's already making your caramel latte, whatever that you get, right? Same thing with a lender. Once you send them, hey, this is the specific deal, I'm going to get it under contract. As soon as we have that contract in hand, we're going to start ordering title, insurance, appraisal, because we know those are those trusted partners that we are using for the third-party items, right? So it really just speeds up the process to where we already have docs, we already have a contract now, so we've already started making that coffee before everything's even in place, before we even got to the front of the line, made the order and put the credit card in.
Right. I think another one too is the importance of track records, right? So we've talked about it in past episodes on products, is understanding the borrower's track record. So if we've already done one deal, we already have a good understanding of your experience, or maybe you don't have experience at all, right? But we know what you did on the previous one. So I know that your first deal that you ever did with Park Place, first deal ever as an investor, was $100,000 fix and flip, right? Now I understand your scope of work. So moving forward, it allows us to scale up your strategy, but also your leverage, right? So as we go through the process and we do more and more loans, your leverage is going to be increasing throughout time. And then also, I think the biggest piece of this, and we touched on it, I think 2 episodes ago, is problem solving, right? In real estate, you'll come across problems at almost every angle, whether it's title, insurance, appraisals, like you name it, we're going to come across a problem at some point, some fashion. You're trusting that your loan officer can solve those problems is key, but also as a repeat investor, we are a lot more willing to get creative on how to solve maybe a potential issue or problem that comes in the door, knowing that we have trust and faith that you will get to the finish line because you've proven it previously on other projects.
Yeah, absolutely. And especially at Park Place, since we're not a huge company, right? I'd say we're a mid-sized lending company in terms of personnel. You guys got to know that when you are a repeat client, not myself, who's your loan officer, knows you, right? Our underwriter knows you, our management knows you, our draw teams know you, our servicing teams knows you. Not knows you personally, right? But we know your files, we know your experience, we know what your liquidity position is, we know every deal that you've done. So the communication internally is much smoother in terms of, hey, I've got Ron, client, whoever it may be, he needs an exception on this. Those people already know who he is or know who the investor is. So they're more likely to jump on that real quickly. Let me take a look at it. Yeah, perfect, because I know last time we did this, or this previous time we did this, we're good. And
never had a late payment.
Never had a late payment. Have, you know, maybe we're in a position before that they were able to get out of, and they've proven that to us. And then not only that, we know that our investors like these deals as well that they're doing, and they have confidence that the investor is actually going to complete the project. So on all fronts, having a relationship to where you've done multiple deals with the same lender is super, super helpful in all aspects of the lending game.
Yeah, absolutely.
Connor, we've spoke about why a relationship is super important, the benefits to having a relationship with a lender, but I think we should talk about how to establish a new relationship with a new lender, and how to stand out as a good investor, a good borrower, so you can establish a relationship moving forward.
Yeah, I think the first key part is communication, and clearly communicating the product, right, or the project. So, like, when you bring in a deal, we want to know all the details up front, and I want to know all the good, and I want to know all the bad, right? And
all the bad more, to be honest.
Exactly.
Right?
I prefer all the bad day one, because what I don't want to do, and the worst thing a lender does or can do, is they find out the bad 6 days into your project, and you got a 10-day close, and all of a sudden now we have to go to you on day 6, and it might be a problem you already knew might come up. You just withheld that information, hoping that it wasn't found, right? And so, kind of looking at that as from like an investor standpoint, let's say I'm getting a property under contract and I know maybe there is a lien issue or maybe there's a foundation issue. When I'm having that initial conversation with a lender, I want to be upfront about that and communicate what I could potentially see an issue. That allows the lender to kind of go in and problem solve. Right,
Sure.
so they can figure out a solution there. Maybe it's an inspection. Maybe it's adding something to your budget to remediate the issue. Or, for example, there's so many different ways of problem solving in this space. I think understanding that, but we don't know what you don't tell us, right?
For sure.
So I think that's kind of the first one. And then the second one is, once you've communicated that, like, be able to answer the phone. I think that's the biggest piece, is like, if we call, we're calling you about something on your file, and so communication on that side of like answering the phone or being able to make yourself available, and same goes for the lender, right? We have to make ourselves available at all times. So like, I think that's one of the things a lot of people at Park Place pride themselves in, is if a client calls, you answer. And if you're on the other line and you can't answer, you call back within 5-10 minutes, always.
Yeah, so we have the 3-4 ring rule, right? If a client calls you and it's rang for 3 or 4 rings, then you got to try and pick up that phone if you are available. If not, try and call them back as soon as you're done, right? So that's really what we pride ourselves on at Park Place. Our investors are not just a number, our borrowers are not just a number, they truly are client-partner relationships. And going back to your first point in terms of tell us the good and the bad, look, us as a loan officer, and this is my role, right? My role is to be on your team, to gather all the correct documentation to get your loan approved through underwriting. So I'm the liaison, the middleman between yourself, underwriting, and that capital, right, to get your deal funded. And unfortunately, I think a lot of investors come to us and hide the bad because they think it's going to deny their loan from being approved, right? I would say the opposite. Tell me the bad. Let me try and problem solve the bad, because either way, through documentation, underwriting, really everything that we gather on a file is all risk analysis. That stuff is going to come out, right? However, if you tell me that up front, it gives me the ammo to go, all right, let me get this documentation, this piece of documentation, and maybe an explanation. Let me take that to my underwriters early. Let me get the approval exception in writing. All right, fantastic. We've moved past that. Now let's just gather everything else on the file and get it closed. Now, when we're later on in the game, it's real estate, right? Emotions are involved. You as an investor, you feel then under pressure if something comes up, and we're scrambling, we're panicking on the investor side, and us as a loan officer is also put under pressure because we have a time frame that we're always trying to meet for the client. And if this comes up later in the game and we're trying to get an exception, sometimes those exceptions can take a little bit of time and maybe more documentation's needed. it really puts the full deal under stress, even though we still end up getting it closed for the most part. But tell me those issues up front, tell me the bad, and then I'll problem solve for the bad, and then the good just it talks for itself, right?
Right. I think another big piece is being organized, right? The organizational skills of the investor.
Yeah.
When you're sending us documents, it's a lot easier for us to get approval when everything is organized and
Right.
you have everything that's needed. So it's always important when you get with a lender initially, ask what documents they need, right? It's one of the biggest pieces of the puzzle is collecting all the documentation required to get to the closing table. So having, a idea of what that lender is going to require up front is important, but then as an investor, knowing what I need, right? Because it's typically universal across the industry, right? There might be a couple docs here and there that other lenders require that some don't, but across the board for certain products, for example, a ground-up construction loan, permits, right? If you have permits, maybe it's not, or it's a purchase, so you can't get them yet, but plans, and then a construction budget, right? So if we don't have a construction budget, we have no idea what you're building, and if I don't have the plans, I also don't know what the floor plan is of what house you're building. Is it a 1 bed, 1 bath, or is it a 4 bed, 3 bath, right? So understanding that, and as an investor, being able to provide those documents quickly because you are organized and you have all of them on hand allows a lender to move much faster through the process. So I think that's super important as from a lending standpoint.
100%. Honestly, I couldn't agree more. Documentation is one of the biggest pieces to having a successful loan process. And really what those documents do is they tell the story of the deal, right? Your entity documents, it tells you who has interest in the deal, who's bringing the capital to the deal, what the rehab budget looks like, what the purchase price is. All the documents really talk to each other. And being organized with those and getting your lender those in a timely fashion, that loan is going to fly through processing compared to if you're getting piecemeal documents. Because the thing is, we may get one document that tells us one story, but it really needs to be paired with something else. And if we don't have that other document and we get it later on in the process, that can then switch everything that we've thought and we've been looking at based on what has been stated information. So I kind of get this. This is a good example of it in terms of rehab budget, right? If we get a rehab budget initially, we go order the appraisal using the rehab budget. The appraiser is looking at that budget to actually make their valuations on the after repair value. We also look at that in terms of what insurance we're getting, how much coverage we're getting. We also look at that in terms of the loan amount. So if we get a budget and then that budget is not the finalized budget and it comes in 2 weeks later or a week later, whenever it comes in, and we've already got title, insurance, appraisal, and then the budget comes back 50k higher than what was originally said, well, that changes the full scope of the deal. So we'd have to go get an updated appraisal, updated title, updated insurance. And from what was maybe the values on the appraisal as of today, it could change once the new budget comes in. So being organized and really getting everything to us one time at once is super helpful, because we can really do a pre-underwrite of the deal based on the initial documentation sent and try and get ahead of, again, problems that may come up, any issues, maybe on your entity, we're missing the articles of organization, or someone that's on the entity isn't
on the articles,
right? We can get ahead of those problems that will be conditioned in underwriting. So then it's a much smoother process and we have time right at the start. So
I always see it like, in speaking from personal experience, a lot of the files that I've seen go through underwriting that you were given the documents up front because the borrower was very organized and provided all those in a timely fashion, those files typically have way less conditions, if any at all, right? A lot of times you'll see them go straight to closing versus if you have a client that maybe doesn't have all the necessary documentation, it takes them a long time to get it. So maybe you get all the third-party docs back, which is rare, right? You should have all the borrower docs back first, but you get the third-party docs back before most of the borrower's documents. and then you don't have time to review them, and now you're 48 hours away from closing.
Right.
You've got to submit that to underwriting to get eyes on it, while you're also still trying to review what they've sent.
Right.
And a lot of the times they'll start to catch things that are off, or maybe there is a problem, or there's something missing, and it causes delays. And at the end of the day, nobody wants a delay in a real estate deal, because time is money, and also sellers have a timeline, and everything is on a time crunch at the end of the day.
Yeah, for sure. And it gives you really an expedited process, because once we have the documents up front, once we put that file into processing, myself as a loan officer and all the loan officers in the office, we're going to review those initial documents. So you get our eyes on all of them. Then when it goes into processing, you get all processing's eyes on them. Then when it goes into underwriting, you get all underwriting's eyes on them. If we've all seen all the documentation right from the start and we know the story, if there's any issues in underwriting, myself as a loan officer can say, well, no, I've already spoke to the client on this. They've already provided this. Okay, problem solved. And we can move through that underwrite process much quicker. And like you said, a lot of the times I've already got ahead of things, and that file usually just goes straight to closing. So.
Yeah, and I'd love to give a real life example here, right? And so recently we saw a deal come in the door, and we noticed it was a wholesale deal up front, and we had asked for the wholesale front side agreement, so we kind of understood what that wholesale assignment fee was. And for those that are watching, to explain what a wholesale fee is, you have a seller who is basically under contract with a wholesaler. The wholesaler is not actually going to be purchasing the property. They are going to assign that to the end buyer, which would be the investor, right? So there's the sale price, and then there's an assignment fee. As a lender, we typically want 15% max, right? And at this time for this scenario, the purchase price was $100,000. And, well, sorry, let me back up. The purchase price was $200,000. But we had noticed that the seller on the contract was not the owner. It was a wholesaler. It was an assigned contract. And so we had been asking for the front side. And it took about 5 days to get the appraisal back. We got title back already. Before then, we already had insurance. We had borrower docs. We did not have the wholesale agreement. We were not able to track that down, and we had to submit to underwriting because it was supposed to close in the next 72 hours. As it's in underwriting, they conditioned for it. And once we got that wholesale agreement back, we saw that the front side was $100,000, right? Which is a $100,000 assignment fee.
Yeah.
That is too high, because at 15%, the max purchase price would have been $115,000, right? And so that put us in a bind with the borrower to where we needed more money down, and there was a lot of things that came up last minute that could have been well avoided had we had the documentation up front. So little things like that are why they are so important to get us documents quickly.
Yeah, for sure. And it helps with the relationship, going back to that, because we can catch things early. If you catch things early, no one's frustrated.
I don't want to call a borrower a day before closing and request more cash down.
Yeah, the contract, you got to put more. We could have known this a long time ago if we just had that right documentation, right?
And if it doesn't work for the client, then I haven't put them in a bad spot. They have time to go to another lender who maybe doesn't look at wholesale assignment fees like that. And that's what I prefer. I'd rather give you that information up front than put you through a process and then come back at the finish line. But it's because I only know what I've been given.
Yeah, absolutely. So tell us the bad.
Yeah, exactly.
That's what we're saying. What I also want to touch on is, which makes a really good relationship up front, is loyalty. So we as a lender are going to be loyal to you as a client, right? In terms of, if you need something from us, we will get that. We'll be effective with our communication. We'll make sure that we're fighting for every deal that you do bring in the door, as long as it fits what we're looking for. And we look for the same thing from the investor, right? It's a partnership. Yes, we are at the end of the day that we're a service for them, but still, I think there should be the mutual respect between the lender and the investor, because really what I'm getting down to is, if I'm a loan officer and I'm spending hours on your deal, and then a client then goes and starts shopping for a better terms or whatever it may be, me as a loan officer, I don't get paid, right? So I basically work for free for that. So if you were to then go shop and maybe that deal fell through, and then you decided to come back to me a couple of weeks later to finalize documentation, and then you put me in a bind to try and really push your file to close, trust me, I'll do everything I can to get it closed. But at the same time, that's not a good step forward to creating a long-term relationship with myself as a loan officer or with Park Place, right? Because really, I value the service that I provide and what Park Place Finance provides throughout all our loan officers. And we really take pride in what we do in terms of getting a client from start to finish. So if you trust in us and you're loyal to us in terms of bringing us that repeat business back, I can guarantee you that we'll establish a relationship and you'll get all the benefits that you have, which we spoke about earlier in the episode.
Same thing as trust. Loyalty is a two-way street. We got to provide it, and the borrower's got to provide it back. And that's kind of the foundation of a long-lasting partnership relationship with a client.
Yeah.
All right, to finish off this episode, if you are a broker or investor watching and you're looking to build a long-term relationship and you want to build one with your trusted lender here at Park Place Finance, make sure to check out our website and reach out to us today. We're happy to help.
That's it for episode 8 of the Loan Lads podcast. Meet us next week for episode 9, where we'll be going into some more juicy stuff about lending.